A very good morning to all. In today's session, we're all going to learn that how to finance an enterprise. So let's begin with the overview of finance. Finance is a term which always describe that how a particular individual or researcher study the system of money, the investment options and the other financial instruments. In other words, finance can be divided into three main categories. The first one is the public finance, corporate finance, and the last one is the personal finance. There are also a subcategories of the finance that could be called a social finance and the behavioral finance. The history of finance and the financial activities are also being to be back to the dawn of civilizations. Finance has a rooted itself in the scientific fields like the statistics, economics, mathematics, but also includes the non-scientific elements which could be called an art. So finance refers to a system or a study of creating, circulating and managing money. It's all about that how an individual deals with the monetary terms and when the investment decision has to be taken up and how an individual take up a meaningful decision to circulate and finance manage the money. The next section are the sources of finance. In every business, capital could be arranged either two sources, the internal sources and external sources. So let's have an overview of uh, all these two sources. So the first one is the internal sources. So when the entrepreneur manage the funds from within the enterprise, that is exactly called the internal sources. It could be through the, or you can say, owners own money. That could be, in other words, called an equity capital, and it also includes the deposits, loans given by the promoters or the directors, with whatever the case may be. Sometimes promoters is also raise the personal loan on their investment in the life insurance policy or the provident funds, fixed assets or any other type of investment. So if a business is already running, the entrepreneurs retain a part of their earnings so that whenever any investment takes place, they will plug back in the business for expansion purposes. And these retained earnings may not be a very huge amount for the small enterprises, but somehow it could also term as a form of internal sources. The next sources are the external sources. External sources is also includes all other sources which are not internal but termed as external, because the external sources of funds may be further divided into two main parts. The first one is the debt financing and the second one is the equity financing. When we talk about the debt financing, it includes all those borrowings from banks, from any other financial institutions, so that they can meet up the short-term needs like working capital and the long-term needs like term loans, capital requirements. It also includes the issue of debentures as well, while the angel investments or venture capital investments or the private placement or the private equity can also be a part of the equity financing. The next concept is a capital structure. It is the most crucial equipment of starting a business, that's called capital, and it also plays a major foundation role of the company. Debt and equity are the primary types of the capital sources of any business, and what the capital structure means is it is defined as a combination of two primary capital sources like you can say equity and the debt, which could be put together into a use by the company so that the company could finance the overall operations of the company for its success or growth, and that is exactly called the capital structure. In other words, capital structure can be described as an arrangement of the capital by using up the different sources of finance. It could be the internal, it could be the external according to the requirements of the company. Other different sources could be the long-term funds, which consist the two major type, equity finance or the debt financing, or the other there are different types of funds also which could be raised by the company, which includes the preference shares, equity shares, retained earnings, long-term loans, etc. Now we can come up to the types of capital structure. The first one is the equity capital. Equity capital is the money owned by the shareholders or owners. So it is a part of the shareholders or the owners of the company. It consists of two main types. The first one is the retained earnings. Retained earnings are also a form of the profit which could be kept separately, and whenever the needed for the expansion or for the further investments of the project, the particular owners or the shareholder are plumb back that part of the profit and used for the expansion for the overall growth of the company. The next one is the contributed capital. It is the amount of money which the company owners invested at the time of the opening of the company or received any form of money from the shareholder as a price for the ownership of the company, and that is exactly called the contributed company, where the company owners and the shareholders somehow contribute the money for the overall ownership of the company. The next one is the debt capital. Debt capital is referred to a borrowed money which is utilized in the business. There are different forms of debt capital as well. The next, the various types of debt capital, and the first category are the long-term bonds. These type of bonds are considered as the safest form of debts. They are the extended repayment period and having the interest which could be paid when the principal need to be paid at maturity or a due date. Second type of debt is a short-term commercial paper. It is a type of the short-term debt instrument which is used by the company so that they can raise a capital for a short period. The next section is the optimal capital structure. There are various factors which should be considered by the organization to reach the optimal capital structure. So the optimal capital structure is referred to perfect mix of the debt and equity so that the business could take a meaningful decision to financing the project, and also helps to maximize the value of the company and the market share at the same time to minimize the cost of capital. Capital structure is also depends upon industry to industry. For a company which involved in mining or petroleum or the oil extraction, a high debt ratio it's not suitable. If the high debt ratio is involved in such industry, it could also incur the huge losses. But some industries like insurance, banking have a high amount of debt which could be a part of their capital structure. So there are various factors which need to be considered. That the first one is the financial leverage. Financial leverage is a proportion, is refers to a proportion of debt which is a part of the total capital of the company. It is also, in other words, we can also call it a capital gearing. A firm having a high level of debt, it's called a highly leveraged firm. Or who are having a lower ratio, we can call a lower leveraged firm. The next factor is a risk of cash insolvency. The risk of cash insolvency arises due to the, you can say, failure of the fixed interest amount, or termed as liabilities. So once the higher proportion of debt in capital structure, which always, you can say, harm the company to pay the higher rate of interest on debt in respected that the amount of fund has been taken from the bank, or whichever is available or not. So the non-payment of any interest, it leads to losses for the company on that firm, or it could also leads to a liquidation of the company. The next factor is a risk in the variation of earnings. So if a firm faces a higher level of debt, so automatically it influences the overall capital structure of the company. So, and it could also leads to a higher level of risk of variation in the expected earnings which is available as equity shareholders. So automatically the funds it always refers to a funds which could be added to a long-term debts which should exceeds the interest rates, and the shareholders should always pay a higher return, always receive a higher return rather than pay the higher returns. Next is the cost of capital. Cost of capital means the cost of raising the capital from different sources of funds. So it could be termed as price paid for using the capital. Any organization should also generate the enough revenue to meet up the cost of capital and finance its future growth, and it is a duty or a responsibility of the finance manager who should consider the cost of each source of fund while deciding the overall capital structure of the company. The next is control. The consideration of retaining the control of the business is also the important factor of the overall capital structure decisions. So if the existing equity shareholders do not like to dilute the control, so they may prefer the share capital or a equity capital, as they don't have exact voting rights. The next factor is a trading on equity. The use of fixed interest bearing securities along with the owner's equity are the main source of the finance, which called a trading on equity. So in other words, it is also refers to an arrangement by which a company focus on increasing the return on equity shares by the use of fixed interest bearing securities like debentures, preference shares, and that is exactly called trading on equity. The next factor are the government policies. Capital structure is also influenced by the government policies or any rules of regulation of SEBI or any lending policy of the financial statements, which could also change the financial pattern or the position of the company. It also includes the monetary and the fiscal policies as well, which ultimately influence the overall capital structure decisions. Next is flexibility. The capital structure of the company should also such that it could raise the funds as whenever required. So flexibility is also provides another platform to expand the business. Next is the period of finance. The period for which the finance is needed is also influence the overall capital structure. When the funds are needed, either the short, long period term or the short term, and through on what basis, either by rising the issuing of debentures or the preference shares or the equity shares, or the funds should be raised by the issue of equity share. It is also needed to decide permanently. The next is a nature of business. It is a great influence of the overall capital structure of the business, where the companies having the skills certain earnings which always prefer the debentures or preference shares rather than equity shares. And of course, when a company decide to take a decisions upon the nature of the business, it also depends on the internal sources as well. The next factor is a legal requirements. The finance manager should also equipped with the legal provisions while designing or deciding the overall structure of the company. Next is the purpose of financing. Capital structure of the company is also affected for the purpose of the financing. So if the funds are required for the manufacturing purposes, then the company should also procure while for the issue of you can say long term sources. Next is a cash inflow. The selection of the capital structure is also affected by the capacity of the business to generate the cash inflows. The next one is the provision for future. The provision for future requirement of capital should also be considered when the particular entrepreneurs or the shareholders plan the overall capital structure of the company. And the next factor is EBIT EPS, earnings before interest and taxes, and earnings per share analysis. So it is also a tool of analysis when a company decide to analyze the earnings before of tax or earnings per share. So if the level of EBIT is low from the EPS, then of course some companies might issue the equity or preference or to debt. If the EBIT is high from the EPS, then some view the debt you can say financing is more preferable than equity. And if the return on investment is less than the interest on debt, then the debt financing decreases the return on earnings, ROE. And when the returns of you can say interest is more than the interest on debt, then the debt financing increases the return on earnings. So these are the rules of analysis. So when a company will come up to a meaningful decisions regarding the capital structure of the company. The next section is a stage of business development and source of funding. So when we talk about the first stage of any business is pre-seed funding stage, where the entrepreneurs must look after the ideas on which the funding is to be granted, and this is a test of the entrepreneurs to check the feasibility of the idea and accordingly conduct the market research, where the research involves no customer or market. So once the idea seems feasible through the market research, business moves to the next stage called the startup stage. And when we talk about the startup stage, it refers the prototype of the product or the service is ready. So testing of the product or testing of the services is now ready, and the company is accordingly do the testing and come up to the meaningful findings of the market research and the pilot study where the changes are to be made in the product or service concept. The next stage is the seed and the startup stage. So both are the, you can say, preliminary stage of the venture development or any product development. So the business in these stages is totally depend on the own money. You can say the personal savings we can talk about, or the borrowing from their family and friends. So once the exact decision is to be taken by the entrepreneurs, then they can also avail the government grants at this stage. So these days the entrepreneurs can approach the angel investors who can invest their on their project, on their product, and of course that is also you can say crowdfunding platform to find the business needs at this stage. In the next stage, now the customer base is ready and the entrepreneur wants to expand its business with a new product or service. So this is the early expansion stage where the venture capital investors always helps the entrepreneurs to raise the funds and expand the business through the series of funding. It could be through the angel investors, it could be through the venture capital investors, it could be through the government grant, it could be through the any financial institution, it could be through the issue of preference or the debentures. So once the startup is matured and at this advanced stage, the entrepreneurs can also think of raising the debt capital from the banks and the financial institutions. And at the last stage, when the startup wants to grow further and diversify the option of offering the shares to public, that is called initial public offering, or a private equity or a private placement of shares can be considered. And this is the last stage of the startup funding stages. So these are the options where the company can use and raise the capital for its product. The next section is its bootstrapping techniques. Bootstrapping techniques is based on the principle a penny saved is penny earned. The organization is always use the used resources, which could be termed as a collection of methods to minimize the need to seek outside finance by the startup companies. Every successful company would have applied such techniques at the initial stage of their venture development. At this stage, where the investors are not willing to invest or risk their money, so bootstrapping techniques are the good option for the ventures, for the companies to bring them on self-sustained mode. And these techniques also brings a discipline on the pattern of the cash outflow, rather than use the penny of its own instead of borrowing the penny from others. Let's take an example: buying used equipment instead of investing in a new ones, renting the physical space instead of buying the land or buildings, working from home to save upon the infrastructure cost, availing the discount from the supplier. So in these example, it is more about to save, it is more about to use the old resources rather than making an investment in the new ones. Use of the credit cards to pay for expenses rather than using your savings. Easy loan from family friends could be better option to save upon the interest cost. Sharing of equipment, employees, and office space for cost saving. Employing their relatives and friends at below market salaries. Obtain the advance payments for customers. So these are the examples of the bootstrapping techniques where the particular companies or industries use to save the penny while earning. What are the advantages of bootstrapping techniques? Since the entrepreneurs do not raise any equity, any debt funding, so bootstrapping their ventures. Just use your own ideas, use or raise the money within the internal perspective, and it gives a complete freedom and flexibility to them to implement their strategies. So there is no interference of any investor during the operation of its business. They can also retain the complete ownership of the business as there is no involvement of the external investors. It is also one of the source to build a business from scratch without any support of any investor, and somehow it also gives a sense of achievement, accomplishment of the entrepreneurs. Limitations. Too much bootstrapping techniques could also prove to be risky. So somehow there could be a liquidity crunch. Sometimes it limits the ability of the startup to scale up and reaches to a full potential without any support of investors. While while boot while bootstrapping, the entrepreneurs might be a multitasking, which at times may be stressful or may be time consuming process. The entrepreneur must have to work simultaneously, you can say, to keep the records of the cash flows rather than need a more focused, organized, or systematic, you can say, manner. The risk of failure would be more because nobody knows that the techniques that the particular organizer or entrepreneur using, whether it could be successful or not. So automatically the risk is more involved without sharing it with others investors. The next concept is the angel investor. Angel investor is also known as seed investors, who having a high net worth individuals who invest directly into the promising entrepreneur businesses in return for equity shares in the companies at the initial stage of their venture development or a product development. So if any company come up with a promising product development or any venture project, so definitely they can go to the angel investors, and they just want the you can say the return for equity shares in your companies at the initial stage, and that investors are called angel or the seed investors. Investment is also known as the informal risk capital, as their investment approach is not very professional or a formal, such as venture capital investors. So venture capital investors are a very professionals and the formal way of dealing their promising projects with the you can say venture capital investors, and these terms are originated with funding of Broadway plays in the early 1920s and 30s for getting the production of the ground. Let's talk about the features of angel investments. As you can see, unlike the traditional investors, angel investors invest in unconventional or highly risky investments. Angel investors bridge the gap between the early founders, friends, family financing, and the later institutional financing. Many angel investors are the entrepreneurs themselves, as well as the corporate, you can say, leaders, professionals. So they have a very good knowledge of technology or business auction. Angel investors not only provide capital but also provide the guidance on the non-financial purposes. They mostly invest locally because they believe in hands-on approach. They regularly visit to the investees and are involved in the strategic decisions of the company. They can be done better. They invest locally. They are informal investors, and their decisions to invest in the startup is mostly driven by references. So when a startup is referred by the past investees, friends or consultant, it becomes more easier for them to rely and invest in such referred enterprises. Now we can talk about the reasons for investors. What are the reasons for such investment? As many of the angel investors are entrepreneurs themselves, so they know the common problems the new entrepreneurs face. Next, sometimes the angel investors want to support the entrepreneurs from their home ground or native place. They have the entrepreneur spirit, and of course they always moved by their, you can say, bunch of innovation and creativity. So ultimately they could also help to the new entrepreneurs for such innovation and creativity. Angel investors are successful entrepreneurs and business leaders, and society are given enough name and fame and wealth to them. Beyond all these reasons, investing in emerging business ideas and what the angels investors want to contribute their personal skills and contacts to the entrepreneurs. Angel investment networks in India. Angel networks is a formal association of the angel investors and provide such a platform to all those entrepreneurs to raise a seed funding. And these networks basically connect the entrepreneurs with the interested investors. And there are many such networks active in India, such as India Angel Network, Chennai Network, or you can say Rajasthan Network, Hyderabad, and so on. And such networks have different objectives and governing structures regarding the sources of investments and deals, or evaluate or involve with investee, and finally you can say existing from the portfolios companies. Angel investment scenario in India. According to the Indian Venture Capital Report 2021, India is one of the leading startup India globally. Indeed, this development is reflected in the growth of angel investments in Indian startup, and such report shows that the investments by angel investors increased 24% to 34% deals in 2020 from 275 in 2019. Venture capital investors. What are the venture capital investors? Venture capital investors are also called an equity investors, such like the angel investors. They invest in a high risky projects or business ideas, while the traditional investors prefer to invest in businesses with proven technologies. So venture capitalists are eager to find those projects where the entrepreneurs are pursuing something new and explore areas. Venture capital funding is raised to scale up the existing operation or to develop a new product or service. Such concept is a formal risk capital, as the approach of venture capitalist is more professional or formal as compared to the angel investor, which I already stated earlier that venture capital investors are more professional and formal as compared to the angel investors, because angel investors are more informal. So automatically, when venture capital invests to the early expansion stage for the equity in the ventures, so they share the ownership with the promoters, they are active investors and provides hands to hands approach to the management team. Let's talk about the history of the venture capital. The concept of the venture capital is originated in 1946 when the journal Doctors set up in the American Research and Development Fund in its Massachusetts Institute of Technology. Its journal Tortoise is also known the father of the concept of the venture capital. And in India, the government issued a set of the guidelines for venture capital industry in 1988. And this culture of venture capitalism began during the period of liberalization in India. So venture capital industry in India is regulated by SEBI, and Indian Venture Capital Association is the apex body which is set up by the leading industry professionals in India, and one of the main purpose is to promote the private equity and the venture capital industry in India. The structure of the venture capital funds. A venture capital invests in the ventures through a fund, and this fund is called, it should be namely in the form of partnership. They save the journal partners and investors provide money to set up the fund known as the limited partners, like insurance companies, universities, endowment, pension funds, etc. While the journal partners are the active investors, they assist and advise the portfolio companies as well. Journal partners also get the annual management fees up to 2% of the capital invested. And such partners are more accountable in terms of the performance of the portfolio companies, and of course leads to a stricter due to the rules and regulation and diligence. Features of the venture capital investment. Venture capital tend to invest in a high risk unconventional ventures. They funds in the companies for a long term period. There is a defined you can say exist for the venture capital investment, which is a plan at the time of structuring the deal. Venture capital not only provide funds but also plays a very active role in the management of the firms, as venture capital actively involve and assist the investors companies. So such situation or such companies under such situation grows in the future. Venture capital investment Indian scenario, as the startup trend is raising in India and the support ecosystem is also developing in India. So as it can be seen in the figure 7.4, there is a substrate in the figure where numerous data in the tabulation form has been substituted, but here I also stated in the paragraph form. And that's why it has been mentioned here that there is a substantial growth in the venture capital investment in terms of value as well as the number of deals. In the year 2021, the number of deals almost doubled from 1106 in 2020 to 2067 in 2021, which ultimately reflect the growth of 87%. Contribution of deal value is observed to be around 12% during this growth period. It can also interpreted that as compared to the deal size, the number of deal has also increased considerably. So let's talk about the distinguish between the venture capital investors and angel investors. Investment size and stage. In case of the venture capital, larger amount, that is $1 million to $100 million at later stage, that is a series A and beyond. Angel investors are the smaller amounts, that is $25,000 to $1 lakh at the earliest stage, that is pre-seed or seed stage. The next criteria is the funding sources and the screening process. Institutional funds form, you can say, limited partners, like for example pension funds, endowment, rigorous due diligence and the formal agreements. Angel investors refers to a personal funds from individual investors with less formal evaluation or negotiation system. The next criteria is the equity, stake and the post-investment role. Highly percentage is involved, 20 to 50%, with more control and influence over strategic decisions. But lower percentage, like you can say 5 to 2%, with less involvement and interference in daily operations of the business. Investment criteria and approach to risk. Focus on the scalable and the proven business models with clear exit strategies, like initial public offer or acquisition. In case of the angel investors, willing to invest in innovative and untested ideas with a larger, longer term period. The next concept or section is a term loan. As the name suggests, term loan is the loan for a particular term, and this term could be the short term and the long term. Short term is up to 1 year, and loan of any duration beyond the 1 year is considered to be long term loan. Short-term bank loans are availed to meet up the working capital of the company, and the term loans refers to a long term which can be range from 5 to 10 years or 15 years depending upon the nature of the project. Features of the term loan. The purpose. The purpose of such concept can be expansion, diversification, modernization, or replacing the old machine or renovation. Currency. Term loan can be availed in Indian rupees as well as the foreign currencies too. Security. Term loans are always secured and the assets which are financed through repo loan, or you can say, become the primary security against such loans. Repayment. Term loans are to be repaid along with the interest. Bank or financial institution will conduct the credit assessment before granting the term loan, and interest rate will be charged according to the credit risk of the candidate. You can say moratorium period. Some banks or financial institution grant the moratorium period, you can say, to the enterprises, and this works as the grace period, or during this period the borrowers are not required to repay the amount under the, you can say, equated or estimated monthly installments, says in short we can call EMI. Next is restricted covenants. Some banks and financial institutions always put a restrictive covenants on the borrowers to protect themselves from the default or credit risks. The next concept is business plan. Business plan is a formal document which outlines that what would be the company objectives, strategies, or the financial forecast, which serve as a comprehensive roadmap for business growth and development. Business plan are very crucial while they are have they when while the entrepreneurs faces a startup or offshoot of the existing business. They also helps to arrange the launch and the growth of the business. For startup, business plan plays a very significant role in funding to get funding from the investors or banks or venture capitalists or the angel investors. For the established companies, the business plans serve as a strategy planning or you can say guiding a long-term operation and achieving the business goals. Next is key components of a business plan. The first one is the executive summary. The particular entrepreneur must have an executive, you can say, presentation which offers a concise overview of the entire business plan. Next is business description. This particular section elaborated what would be the business idea, what would be its legal structure, its unique value proposition, and the market needs which aims to fulfill at a right time. Next is a market analysis. The market analysis section provides a detailed explanation of the industry, about the market environment, target audience, competitive landscape. The next is organizational structure. This section outlines the company organizational structure, detailing the roles and responsibilities of the executive, the overall management and departmental structure. Next is products and services. This area describes the products and services offered by the company, which overall describe the description of the you can say product life cycle, the intellectual properties rights, or any research and development activities. The next is a marketing and sales strategy. This part of the plan outline the strategies for branding, marketing, sales approaches, and the customer acquisition. Next is a funding request. For startups and business seeking funding, this section is specified the amount of funding needed to the entrepreneurs. Next is the financial projection. The financial section provides the projection of the business financial performance over the next 3 to 5 years, including the forecasted income statement, balance sheet, and so on. Appendix. Appendix section includes any additional information which to be given by the researcher or entrepreneur that support the data included in the plan. It could be a resume of the management team or any legal agreements or any technical specification or any other relevant required. The next section is a technical analysis. Technical analysis, in other words, we can also call the technical feasibility. It consists to analyze the technical and the technological aspects of the proposed idea. It consists of the 5 subparts such as location selection, technology selection, capacity planning, production planning, and the operational planning. The first part of the technical analysis or feasibility that could be location selection. It refers to a selection of the area or the place to set up the manufacturing unit of the or any service center. The next part is a technology selection. It is very important section to handle a routine business activities, maintaining records, order processing, inventory management, database management of customer, database management of supplier, how to do an internal communication, cost tracking, human resource management, and of course how they connect with the customers and supplier. That is a part of the technology, and to choose the appropriate technology that to be studied by the entrepreneurs. The next one is a capacity planning. Capacity refers to a maximum output that a company can produce with the available resources in any given time period. Next is production planning. It is applicable to the business organization which involved in manufacturing industries. The entire manufacturing process reflects in the form of flow chart or a process chart, where it means the machine and equipment needed to perform in the manufacturing process. It should be in a organized manner. The next stage is the operational planning. It refers to a sequel step describing the flow of goods and services right from production to customers must be stated. The company should also highlight the what quantities of raw materials or the manufactured goods would be stored, how it managed the stock or inventory and reaches from production to the customer stage. A stock register is effective, a tool of inventory control, even various method to manage the stock, to keep a record of the stock using the LIFO and the FIFO method. And the storage needs and the cost of the same is also mentioned in the operational planning. The next concept is the environmental analysis. Environmental analysis, in other words, we can call the environmental scan. It is a separate tool used to identify and access all the internal or the external elements in the business environment, and the elements which could also include the short-term and the long-run impact on the environment, and how the organization respond to them when they appear. The environment analysis assists the organization to define the factors which influence their business operations, and it also takes the advantages of opportunities and reduces the threats. This concept is also plays a very significant role in the strategic planning, which aims to help the business systematically approach their decision making process and the way organization can achieve their business goals, and of course propel their performances and reach to the new heights. Let's talk about the component of the environmental analysis. It consists of the major components: internal factors and external factors. The first one is the internal factor. These components ask the organization to look inward. They assess the organizational strong and weak points based on their mission and vision. And of course, these factors may allow the business to reflect their direction and plan in a set period, say 5 or 10 years. External factors, on the other hand, refer to the high level consideration that exist outside the organization. Examples of the environmental analysis: environmental impact assessment for a new highway. When planning a construction of a new highway, the environmental impact assessment, that's called EIA, is essential to evaluate the potential environmental effects and ensure the sustainable development. The next is data collection. The EIA team collects the data on the local ecosystem or the water sources, or you can say the quality or the noise level. Then analysis. Using the statistical analysis and predictive modeling tool, the team assesses that how the highway might affect the local flora and fauna of water, or you can say runoff patterns or air quality. They examine the scenario such as the increased traffic and potential pollution. And the last is mitigation measures. The team take remediable measures based on the findings such as wildlife corridors, noise barriers, water management system as well. And these measures is also aims to minimize the negative impact and enhance the highway environmental compatibility. What are its type? What are the types of environmental analysis? The first one is the pestle analysis, SWOT analysis, Porter 5 forces, and the next one is the business opportunity guidance. So let's have a first view, pestle analysis. Pestle analysis is always be termed as a shorter form of the pest analysis, which aims to describe the factors which influence the business on the larger scale outside the organization. It provides the organization about the insights into the market status based on the high level trends, mainly focused on the market, customers, technology, and more factors related to the entrepreneurship. If the company successfully monitor the pestle factors, it could potentially gain the advantages over the competition and increase its sales. So let's have a pestle analysis section. The first one is political, economic, social, technological, and legal and environmental. Political is all about the local and state and federal government policies. Economy is all about the unemployment, poverty rates, growth rate, foreign exchange rate, etc. Social is related to the demographic trends, consumer buying behavior patterns, wealth distribution, attitudes and options. Technology is all about the new technological discoveries, the products, what would be the research and development areas into upgrade the technologies. The next is the legal, related to the health and safety regulation, unemployment laws, labor laws, product regulations, etc. And the last one is environmental, that what would it refers to be a, it refers to climate and weather condition, energy consumption regulation, and environmental policies, etc. That's all for today. Thank you so much for listening this lecture. I will come up to a more interesting and important topic. So till time, thank you and namaste to all.